today talking about some timely issues, including business entities. We got some tax strategies, and that's very timely right now. I also have a business and real estate attorney with us today talking about those business entities and what might be the best type for you. And we also have a retirement expert, and I'm kind of like the quarterback as a financial advisor with Raymond James, and these guys are kind of on my team. And we're going to talk about some, those types of issues. But let me just kind of tell you a little bit about what I do, and then we'll go into the panelist section. I'm just my little bit of my story is I've done a number of different things in my career, in my life. I spent a lot of time in real estate back in the 90s, and I was in South Florida and Fort Lauderdale. And when I started, I wondered what I would do to get people's attention. I think I was one of the first real estate agents to pair their dog with their picture. And I was known as the canine realtor, and everything I did had to do with dogs. So my newsletter was called Doggone, and I used to talk about all the houses I sold. It was really, really effective. I moved into commercial real estate, and I ended up bringing in one of the largest commissions at Remax Partners. I got two sides of a $15.5 million deal. And the reason I bring that up is that right after that closing was the financial crisis. And so I want people to know out there that are business owners that I have so much empathy for you, because things went downhill after that. Business was hard to get. Things were going into foreclosure. I was struggling to get new business. I was struggling financially. But you'll get through it. Some of the best things happened to me when I got spit out the other side, and I hope that is true for you, and I believe it will be if anybody else is struggling through this, because I know it's not easy. It was the worst part of my life, but it ended up being the best part of my life when I got through it. But one thing I wanted to emphasize is when I was doing well, I invested in my retirement. And when I was not doing well, I never invaded my retirement. I never went into there. I never took any money out, and I'm lucky I didn't, because one of my first investments was with Amazon. I bought 65 shares of Amazon at $52 a share, and that is turned into about $300,000 or $400,000 in my retirement. Thank God I didn't take it out when I was struggling, and that's really important to understand. I understand if you have to, but it should be the last resort. Just to talk about my business is that I'm committed to a seamless financial and lifestyle advisory experience uniquely tailored to you. I've been through it all, and so I can share those experiences with you. There's nothing more valuable than time, and that's what I give to my clients: more time to spend growing their business and their career, more time to spend with their family, and more time to make your unique contribution to the world. I believe in earning your trust by taking the time to get to know you, your values, your priorities, your passions, and your hobbies. And this allows me to create that experience for you. I've teamed up with Raymond James and Associates to surround myself with experts and resources that harmonize all the components of your busy lifestyle to provide timely support wherever and whenever you need it. And our team has decades of experience in a vast array of investment alternatives and solutions that we offer. We work with a wide variety of clients, businesses, small business owners, real estate agents. We help people with successful retirement planning, saving for higher education, estate planning and legacy considerations, and managing life insurance and long-term care, which is a big topic nowadays. My purpose in life, really, and in my business, is to lift others, to help you grow and succeed personally and professionally. And I demonstrate this through my practice, but also through my personal life, through community involvement. And I offer these types of free seminars for different topics. As a seasoned professional business owner, real estate investor, father, and husband, I believe we all have wisdom to share, and I believe we have an obligation to humanity to share it and do it humbly. So now I'm going to get into the presentation. The first panelist of my team is Anna Stevenson. She's a partner at a law firm. She'll tell you a little bit about herself before she goes into her presentation. She's going to talk a little bit about the different types of entities, business entities, and the pros and cons of those entities. And here's Anna. Thank you so much, guys, for hearing me out. And then we're going to put Anna off of mute.
Let me track you down.
Can you hear me? Can you see me?
There you are. We got you. We got you. We can hear you.
Okay, great. So I'm an attorney in town. I've been here a while. I'm also one of the founders of a brewery in town as well. Having started a couple of businesses, I'm uniquely placed to help business owners. And I help business owners with really every aspect of their business, as long as it doesn't involve lawsuits or domestic or criminal issues. But I help a lot of startup businesses. I work through real estate issues, distribution, employee issues, any kind of contract that comes up, and then estate planning, succession planning, and eventually a sale of that business or buying other businesses and growing. So the presentation today is a little bit higher level, and I'll be pretty quick in running through some of these entity issues. And then we'll have a CPA talk a little bit more about the S election and when that might be appropriate. So there are really three basic entity structures. A sole proprietorship, which I hope nobody is, partnerships, limited liability companies, and corporations. So the sole proprietor is really anytime you just start a business and start selling something, you are automatically a sole proprietor. The issues with that is that you have personal liability for business issues, which you don't want. You don't want your personal assets on the hook for any missteps you might have as a business. The next entity form is a partnership, which can be inadvertently formed. And if any of you have seen any of your contracts or independent contractor agreements, typically there's a clause in there that says that you're not creating a partnership. And with a partnership, general partners, each partner can bind the other partner in that business. So you don't want that. You can file in certain situations, depending on what you want to do, which makes sense for sometimes owning real estate and other situations, limited partnership or limited liability partnerships where you have general partners and more limited partners. But really the two main entity types are the limited liability company and the corporation. I typically advise clients to, especially startups, to stick with a limited liability company. The advantages are that it's a more flexible organization. There are less requirements for annual meetings. And it allows you to make special allocations of profits and losses to members that corporations can't. So typically when you're starting out, that's advantageous depending on what kind of investor you have. The disadvantages are that profits are subject to self-employment taxes, but there are strategies around that as well. The liability in a limited liability company is the entity itself. So members are not personally liable for actions of the company itself. You really have to think about a limited liability company and a corporation as a completely separate person that does makes its own actions and has its own insurance, and you all probably are operating as a limited liability company or a corporation. The corporate form, if you can advance the slides, again, the shareholders have limited liability for the actions of the company. It's a entirely separate entity. The disadvantages of a corporation usually are that there are more requirements annually for meetings, for filings, for management, and the way the steps owners have to take, particularly if you're a sole member. You have to have annual meetings with yourself to elect yourself as the board, and then you have to have annual meetings with yourself as the board. So it becomes cumbersome, and a lot of small business owners forget to take those steps every year, which could be a problem down the line if there's an issue. The advantages in some circumstances are the ability to raise capital. Some investors are more likely to invest in a company that is a corporation when they're selling shares versus a percentage interest of an ownership of an LLC. You can have certain benefit plans in a corporation that you can't really have in an LLC, and the company retains the profits. It's not everything is passed through. The disadvantage in that situation with corporations is that they're double taxed. The corporation is taxed, and then the shareholders are taxed. The way to deal with all of that is the S election through the IRS. And a lot of people talk about the S Corp as a separate thing. You're a corporation or you're an S Corp. It's not a separate entity. You're either organized as an LLC or a corporation, and you file the S election. And that is passed through taxation rather than double taxation for a corporation. There are limits on ownership in an S Corp. Typically, all the shareholders need to be humans. There are some exceptions for certain types of trusts, and it's limited to one class of stock. So if you have a separate classes, so preferred stock or anything like that in your business, you're not going to be able to take advantage of the S election. An LLC can also file the S election. So that the advantage there becomes that self-employment tax, there's some savings there over a certain point. So you work with the CPA to figure out when it's going to make sense for your business to file that S election. At that point, you're no longer taking losses against other ordinary income. All of these entities can be changed as well. In recent years, I've been shifting a lot of corporations to the LLC format when they've got bigger investors coming in. And I've seen a lot more of that than LLCs converting to corporations. With the S election, our CPA panelist is going to talk a little bit about when that becomes advantageous and when you might want to do that, whether you're an LLC or a corporation. Joe?
Awesome. Thank you, Anda. And if you have any questions for any of the panelists today, I'm going to have my email at the last slide, and I know that Chad would be able to forward my information, but just send those requests to me and I'll send them to the appropriate panelists, whether it's the Anda or Trevor, the CPA. And speaking of Trevor, Trevor is going to be next up, and he's going to talk about some of those best practices for tax accounting and those entities. And Trevor is going to talk a little bit about himself and a little intro, and then he'll go into his part of the presentation. Trevor, you're up, buddy.
Perfect. All right. So yeah, I'm Trevor Neal. I am a CPA with Sukup Bush and Associates. We're an accounting firm here in Fort Collins. I am primarily, my work revolves around tax work, business tax returns, individuals tax returns, things of that nature, any sorts of tax planning, kind of like year-end tax projection. That's kind of the work that I cover. And then probably about 70% of the work we do here at the firm. The rest of it would be kind of the audit review type projects. But again, I don't really do any of that. My focus is primarily tax. So I appreciate Joe reaching out to me and being able to walk through kind of just some high level questions that we get from new businesses, from clients and things like that. So yeah, to start it off, kind of the roadmap of what we're looking at doing. We've already talked a little bit about the formation and the advantages of the LLC versus the S corporation and the partnership. I'm just going to go into a little bit of detail on the taxing of the different entities. Go over the filing deadlines. Not a lot new there, but just a lot of times questions come up of when you can file, extend, things of that nature. And then we'll go over a little bit the nature of what you can deduct as a business owner. And at the end, I'll go over a little bit. I was asked to maybe talk just briefly about some of the CARES Act and the PPP loan. So at the end, it's not on the slide here, but I will finish up with a little bit of that. So the next slide. So like I said, one of the main questions we get is, how am I taxed and how should I organize my business entity for the different ways businesses are taxed. So the way we look at it, there's kind of two thoughts for this. And I didn't include C corporations in this just because they kind of file their own tax returns and we don't see a lot of them. So the two ways we look at it, we look at a disregarded entity and we look at a pass-through entity. The disregarded entity is the sole proprietorship or the LLC. So if you're a business owner and you report all of your income on your personal tax return from the business, and all of that is done on your personal tax return, that's what we refer to as a disregarded entity. Once you become the S corporation or the partnership, those are what we call pass-through entities, and that's because those types of companies file their own tax returns, and then that income flows or passes through to your personal tax return. So I was asked to talk a little bit about when it might be advantageous to switch from an LLC to that to an S corporation. It really does vary depending on your type of business, kind of your goals for the business. A general rule is, once your net income is around maybe that $100,000 range, is generally when we talk to clients about making that switch, but it does vary. So, if you have questions or concerns about that, that's definitely a good question for your tax advisor, since each business is a little bit different and each business owner's goals are a little different. But just to give you an idea when that break-even point might make sense to switch over, that's kind of the threshold that we generally tell clients. So moving on to the next slide, this is kind of just a chart that I made that kind of visually shows what I was talking about. So the disregarded entity is the sole proprietorship or the LLC, and that money or the money you make from the business all goes to your individual tax return. And it's filed on what you call a Schedule C. The pass-through entities, the S corporation and partnerships, they file their own tax returns. So the S corporation files the Form 1120S, and then whatever income that S corporation makes, it then flows to your personal tax return on the 1040. And in your partnership, that information gets filed on the Form 1065. And again, once you get kind of to that net income figure, that then flows to your personal tax return as well. So that's just more of a visualization of the slide before. So to go to the next slide, this is kind of where I'll drill into the difference between the entities. So one of the main differences is self-employment tax. And basically what self-employment tax is an additional 15.3% tax on your earnings from self-employment. So the way that I like to talk about this is if you're an LLC where the income is filed on your personal tax return, in addition to the federal and state income tax that you'll pay on the earnings, you also have to pay self-employment tax. And essentially what that is it's the Medicare and Social Security that you're paying the government, since you don't pay yourself via W-2, they have no way of getting those payroll taxes. So that's why they take that net figure and multiply it by the 15.3% tax. Whereas when you're an S corporation, S corporations require that as an owner, you receive a W-2. And so with each pay period, you're basically an employee of your own company where you withhold the necessary payroll taxes. And so that's why when you're an S corporation, you don't also pay that self-employment tax on your earnings because of that W-2 that they're already withholding each paycheck. Partnerships, it kind of depends. Sometimes partnerships require guaranteed payments be made to different partners. I don't know if we have a lot of partnerships in here, but basically if you get guaranteed payments from a partnership that you're an owner in, at that point, though, those guaranteed payments are subject to the 15.3% self-employment tax. So that's kind of a high-level overview of what self-employment tax is. And again, it's primarily just because the government is not getting your payroll taxes, so they tax kind of that net figure. So again, it's a little complicated, but that's an overview. I could definitely go more in depth if somebody actually wanted to do that off the call. But to move on, kind of the other questions we get, when are the filing deadlines? If you're an S corporation or partnership, the filing deadline's March 15th, 2021. That's a Monday this year. Like an individual tax return, you can get a 6-month extension if properly filed. So if you do extend that partnership or S corp tax return, then it moves the deadline to September 15th. As I'm sure you're all aware, the individual deadline is April 15th. And again, if you can do a 6-month extension to October 15th, and I put sole proprietorships and LLCs down there just because that information all gets filed with your personal tax return. The next part, kind of eligible business deductions. The main thing here, each of you have kind of your own business. You kind of know what you can and can't deduct. But the main thing that we like to stress to clients is that it needs to be both ordinary and necessary for the business. So a lot of times different expenses that we see are advertising, payroll expenses, professional fees, office expenses, supplies, meals, vehicle mileage, things of that nature. And lastly, self-employed retirement plans. And that's kind of led that in as we lead to Joe a little bit. That's a good tool once you're of a certain size to look at using that self-employed retirement plans to get an initial deduction and then help you save for retirement. So those are kind of the eligible expenses. The next slide I just ran through and put pictures of where your stuff is filed. So if you're an LLC or a sole proprietorship, your form is going to be on the left. That's your Schedule C. That's kind of where all of your income and expenses are shown. And then that flows to your personal tax return. The 1120S, again, is the S corporation tax return. The next page, the Form 1065, is the partnership income and expenses. So just a photo of kind of what that looks like. And again, the S corporation partnership then also go on your individual tax return once those returns are filed. And finally, I put a spot. So if you do have a self-employed, or if you are self-employed and have a self-employed retirement plan, on your personal tax return on Schedule 1, the highlighted portion, line 15, that's where you will end up deducting any payments made to that self-employed retirement plans that you made personally. And ultimately, that just will help you from an individual tax standpoint. So that's kind of all I had for the slides. I know I was going to talk a little bit about the PPP stuff, so I'll kind of just do a high level overview of that. There is a second round of PPP loans that businesses can be eligible for. It's a little bit more stringent than the first round of PPP funding. A little bit different rules, but it's kind of from a big picture, it's the same to where it's, use 2.5 months worth of payroll to calculate the loan. I believe if you're in the restaurant industry, you can actually do 3.5 months of payroll. So I don't know if we have any restaurants owners in here. The big difference between the second round of PPP funding and the first wave is you do have to show that your business saw a 25% reduction in the gross receipts or revenues that you had for the year. So that's really the main difference between these first two is they're really looking for businesses that got hurt in 2020. So they're really looking for that reduction in revenue year over year. The second part with the PPP I wanted to talk about was just the forgiving of the loans. The loans are eligible to be forgiven for now. So if you did get a PPP loan and your bank hasn't reached out to you, just know that you are eligible to get that loan forgiven at this point. And any loan amount that is forgiven is not considered taxable income when you file your tax return. So that's just another note that we've been talking with clients about. So that really wraps up what I had to talk about. So I guess we can move on to the next one, Joe.
Awesome. Thank you, Trevor. Appreciate that. And again, if you have any questions for Trevor, and if we have time at the end of this, Chad will read off some of those questions. But if we don't have any time, I'll leave my email and you can email me those questions and I'll forward those to the appropriate panelists. Next up, we have Mark Schmeckley. He works with me. He is with Principal, and he's going to do a little intro of himself and then go into the different types of plans under these types of entities that make sense for you from a business owner standpoint. And Mark, take it from here.
Yeah, Joe, thanks for the introduction. I appreciate it. Chamber folks, thanks for having us today. It's always exciting when we get to talk to other people besides our family these days. Looking forward to it being in person at some point. But like Joe mentioned, my name is Mark Schmeckley. I'm with Principal Financial Group. We are a retirement plan company. We've been around about 140 years. We're headquartered a couple states away in Des Moines, Iowa. But I am here in Northern Colorado. I live just down the road in Longmont. So it's my job to work with financial advisors, CPAs, lawyers, and business owners to help their clients put small retirement plans into place or analyze and improve the retirement plans they're currently offering to their employees. So today I'm going to talk about 3 types of retirement plans. We'll hit on those at a high level and talk about a few other things that will hopefully pique your interest, and just know that these things start getting pretty in depth. I'm going to keep it very high level. And these are definitely follow-up conversations we can have. So I'm going to talk about this in 2 manners. For those of you that have never had a retirement plan or never offered one for your employees, you can start any type of these plans at any time, and that's something we'd be happy to help you out with and discuss that. Or if you are currently offering any of these types of retirement plans, a big chunk of what Joe and I do is benchmark, analyze, just to make sure that what you're offering is the most efficient plan that's out there, to see if there's any way that you can improve what you're currently doing. So for most small to medium-sized businesses in Colorado, there's really 3 options for retirement plans. The first is a simple IRA. The second is a SEP IRA. And then the third is a 401k. And then we can break that down into either an individual 401k or what we would call a full-blown 401k, or what I call a big boy or a big girl retirement plan. So just at a high level, and you go to the next slide, Joe, the easiest type of IRA is a SEP IRA. And this is something that you can offer as a business owner. Keep in mind, this can only accept employer contributions. So if you're a really small organization, maybe a sole proprietor, it may make sense for you to use a SEP IRA. If you've got a bunch of employees, then we start looking at different sorts of plans down the line. The advantage of a SEP, the advantage of a SEP is that you can put a big chunk of money away, up to 25% of your compensation, or $58,000 is actually the number for 2021. But you have to do that same percentage for all of your employees. So if you're a business owner and you wanted to put away 25% of your pay and you've got 5 employees, you have to put away 25% of their pay as well, right? So that's the downside. If you want to stick a big chunk away for yourself as an owner, you have to do that same thing for your employees. If you've got one other employee or you only have 1099 type of employees, then the SEP might be a good choice for you because you can stick a big chunk of money away and get that invested in the market. If it turns out you don't want to do a SEP and you actually want to let your employees make some contributions to the plan, then a simple IRA can be effective. Simples are a form of an individual retirement account that is sponsored by a business. You have to be a business to be able to sponsor one of these. It allows for employee contributions. So your employees can make their own deferrals into the plan. And you as a business owner or the business itself has to make a minimum contribution. So the limits for a simple, you can put away up to $13,500 in 2021 inside of a simple IRA. But keep in mind, if you're over 50, you can do an additional $3,000, so up to $16,500 for folks over 50. However, you do have to make that employer contribution. And there's 2 ways you can do that. You can do a 3% match, or you can do a 2% contribution to all your employees. Right? So really, really easy to set up, something we can put in place very easily for you if you haven't done a simple in the past or you want to move from a SEP to a simple, definitely something we can look at. The third type of plan I wanted to discuss is a 401k, and this is really for businesses that are starting to ramp up, to grow, and starting to get into that 5+, most likely 10+ employee count, where you really want to offer a full-blown retirement plan. They're a little more complex, but they are very, very easy to run. We run 401ks for businesses with as few as 2 or 3 folks, all the way up to about 90,000 here at Principal. So between us and Raymond James, we make this very easy for you. The advantage of a 401k is you can save up to $19,500 in that account, plus an additional $6,500 if you're over 50. So it really allows you to defer a big chunk of money. Another advantage of a 401k is you have a lot of flexibility around the employer match or employer contributions, all the way from you don't have to do one, all the way up to you can match 100% of whatever employees put in. So lots and lots of flexibility when it comes to that. If you have a 401k, you haven't reviewed some of that plan design, maybe your plan isn't working as efficiently as you can, that'd be something we'd love to take a look at and help you out with. Contributions that go into SEP IRAs and into simples always go in pre-tax. So there's a lot of advantages to that. You lower your tax rate, your effective tax rate overall by having a lower taxable income. Keep in mind, in a 401k, you can elect to put money in pre-tax, or you can use a Roth bucket, which allows you to put after-tax dollars into your 401k. So this can be very attractive for folks that don't qualify for a Roth IRA on their own. You can put that 401k in place and allow Roth contributions in there. So another nice flexible part of a 401k. You can do profit sharing, which allows you to get up to 58,000 and in some cases north of 60,000 inside 401ks. You can offer loans. A lot of great advantages inside of a 401k with a little more work on your part as the business. Next slide, Joe. So just a few things to consider if you currently have a plan in place or you're thinking about putting one in place. There's really 5 key parts of a retirement plan we want you to think about. The first are the funds. You put these dollars into these retirement plans and then they get invested. So you want to make sure you have a really good strategy around selecting and monitoring the funds. That's something that a financial advisor helps you with establishing that initial lineup and then also providing consulting, education, and advice around your ongoing selecting and monitoring of those investments. Fees. You want to be very conscious of cost and fees. There's a wide variety of expenses out there. You can go to low-cost providers, or you can go all the way out to very full-blown, full-service, very expensive providers. Neither is right, neither is wrong. It really is going to determine what you want and need. When you do put a retirement plan in place, you are a fiduciary, which simply put means you have to do the right thing for your employees and your participants. So what are you doing as a fiduciary to protect yourself and to protect your employees? And you want to make sure you have support with that. Plan design, is a simple 401k the right piece for you? Should you be safe harbor? Can you do profit sharing? Do you want a vesting schedule? All types of things that we can talk with you about and help make sure you're doing the right thing. And then what is your current advisor and record keeper doing to help you as the plan sponsor? And what are they doing to help your participants? Are they educating them? Do they help them have a saving strategy in place? Are you getting any type of support? And if you feel that you're not getting any of these from your current setup, we'd love to dig in and help you. If you are, we'll give you a second opinion. But just keep these 5 pieces in mind as you're running those plans out there that you currently have, or if you're thinking about setting one up in the future. Next slide, Joe.
That's it.
Okay, one other thing I did want to talk about is in 2021, Governor Polis did enact a mandated state retirement program. It's going to take place over the next 3 years. So for 2021, any company that has more than 100 employees and doesn't currently offer a 401k, a SEP, a simple, you have to enroll in the state mandated IRA, which is an auto deduct, auto enroll program. For 2022, that number drops to 50 employees. And then in 2023, that number drops all the way down to 5. So in 2023 and beyond, if you have at least 5 employees and you do not offer your own retirement plan, you have to join the state's plan. So I'd highly encourage you to meet with a financial advisor, talk with someone like Joe, talk with your current advisor to make sure you have some sort of strategy in place so that you're not forced into that state plan. It could be that's the right option for you, but just make sure you have everything lined up before you are forced into that plan. But thanks again for your time. Really appreciate it. Have a great rest of the week.
Thanks so much, Mark, and thanks to all the panelists today. I want you to know that I'm kind of like the quarterback here. What I do is I sit down with you and talk about the money, time horizons, your values, your goals. I look at your current situation and then your future goals. And if I find any gaps, that's where we fill in the gap with a plan. So it could be, we have to up your contributions. We have to get you a little bit more diversified. You're lacking life insurance. You're lacking long-term care insurance. Those are the types of things that we analyze. The first meeting is a connection meeting. The second meeting is a clarity meeting. The third meeting is a strategy meeting, and then we put that into play. Just another quick slide before I turn it back over to Chad. The earlier that you get started with a plan, whether it be through your business or individually, like a Roth IRA, the sooner that you start investing, the easier it is. This chart shows how to save $1 million. If you're 25 years old, you would have to save $341 a month to save $1 million with a 7% return by the time you're 65. It goes up quite a bit when you are 35. If you're just starting now, you have to start saving, and it's hard to read, $426. If you're 45, it really jumps up and you're kind of behind the curve. I believe that says $1,920 a month you'd have to save for 20 years at a 7% return to have $1 million, which probably wouldn't be enough to retire on. These days, we're talking 2 to 3 million would be a satisfactory number to retire on. If you're 55 and just getting started, you'd have to save $5,700 a month to save $1 million. So if you haven't gotten started, don't wait, come and see me. I'm actually going to be offering anybody in the chamber a 30-minute consultation, a complimentary consultation. Again, if you just want to ask me questions as well, you can just send those questions in. Email me at joe.marangelo, MORRONGIELLO @raymondjames.com with any of the questions that we might not get to today. If you're interested in the consultation, just put a 1 in your reply, if you'd like just to be added to my email list with updates that I send out to my clients about the market and new things coming up, just put a 2. And if you just have a question, you don't want a meeting or a consultation or be on my mailing list, but you have a question, just put a number 3. I'll get those questions out to the panelists if they're not for me. And again, thank you so much. I appreciate you guys being here. I think I'm going to lose control and turn it over to Chad, but if there's anything I can do to help you, please reach out. Thank you so much.
Thanks, Joe. So we have about 1 minute, and then we'll kind of get everybody out of here right on time. But we do have 2 questions. I think we can probably answer them in a minute or less. First question is, do you expect another income tax extension this year? Or if we can get some clarification on that.
That would be for Trevor.
Yeah, I'll start by saying I sure hope not. I did not enjoy it running into July, but I have not heard anything that there's any intent to extend this year. So am I expecting it? No. Could it happen? I guess yes, but we have not heard anything say that might be coming down the pipe.
Perfect. Thank you. And then one more question is, what are the current qualifications for a Roth?
Mark, you want to cover that?
Yeah, sure. So there's a few things with it. It's a Roth IRA. The government says you have to make under a certain amount of money before you're eligible to contribute to a Roth IRA. So if you're single, your modified adjusted gross income has to be under $140,000 for 2021. If you're married filing jointly, has to be under $208,000 to be able to contribute to a Roth IRA. Now, keep in mind, those contribution limits do not apply to Roth 401ks, just to Roth IRAs.
Perfect. Thank you so much. And then again, to everybody, as you kind of digest the information from our panel today, feel free to reach out to Joe. He will connect you. We're right about 10 o'clock, so let's go ahead and get everybody back to work. So if everybody can put up their red carpet spirit fingers, we can give Joe and his team a big red carpet thank you. I appreciate it. It is good to see you all. Have a happy week, happy weekend. We have an exciting red carpet on Thursday, so keep an eye on those emails for announcements and Zoom links. But everybody have a great day.
Thanks, Chad.
All right, take care, everybody.
Bye-bye.